I think gold is just the first of a number of metals which could do crazy things.
Really?
Silver's up 100% this year.
Yep.
I don't need to tell you that. Look at copper hitting new highs going forward. Mining sector specifically is unusually cheap. So the net effect is that I think by picking your winners, they won't just win, but they will win disproportionately. I am, as I say, remarkably upbeat.
I'm here at Resourcing Tomorrow with Gervais Williams, of course, from Premier Miton, Chair of Equities.
Yes.
Nice to speaking to you again in person. How are things?
Pretty good, actually. Generally it's been a good year. Most people have made money. It's you've not just been needed to be in gold stocks. It's been a very good year in all sorts of ways. In a way, perhaps a little less differentiating, you might have thought. If you'd started at the beginning of the year, I would have thought there would have been some areas which have seen a bigger setback, maybe a downturn here and there. But no, I think AI spend has been so good. That's kept the global economy going.
Okay.
Government overspend in budget deficits has been pretty good. So overall, very good year.
Good. Bit of macro to begin with. Where do you think we are in a sort of macroeconomic environment? I'm getting the sense from some of the places I've been to that it's very much stagflation is the word people are using. I don't know what you think.
Yeah, I think generally, I think during the period of globalisation, capital was available, debt was low cost, inflation was benign. Unfortunately, I think if you look at it in terms of nationalism, I think you reverse all of those. In other words, I think we're going to be a period where there'll be too much inflation alongside deflation. I think both will be there. I think alongside that, I think unfortunately cost of equity is going up. So I think it's going to get harder to fund things, and I think capital-intensive assets might have a good time. And specifically, I think the outlook is going to be it's not going to be very smooth. I think there's going to be a period where there's all sorts of events. I only need to look back in the last 12 months to underline that. So basically, I think it's a much more unsettled world. Bizarrely, I think those companies with capital, listed companies, raising capital from supportive shareholders, actually will have disproportionate advantage.
So when you say you think it might become harder to raise capital, are you talking sector specific or just generally in the markets? Because we've only just in the last year seen it slightly become a little bit easier to raise capital.
No, that's right. I mean, what I really mean is I think markets themselves will produce less return. I think investors will find it harder to find the companies they want to back. I think individual companies unfortunately won't raise capital and will potentially become insolvent. So I think there'll be real downside. On the other hand, I think the winners won't just win. I think they win disproportionately. So I think we'll see a much wider range between the winners and losers than we have previously.
A wheat from chaff kind of scenario.
Absolutely, and as an active stock selector, hopefully something which will be supportive for our clients.
Well, yeah, one would hope so. Yeah. I'm going to ask you how you would then try and sort the wheat from the chaff then, because if it's going to become more extreme like that, obviously you want to try and pick more winners and you do losers in this commodity cycle.
Yeah, what's been interesting really is we've seen such a kind of outperformance of the large US majors, the technology Magnificent Seven as they're called, that actually that's kind of attracted investment capital and sucked it in, and nearly all other companies, not just mining companies, but nearly all other companies have had a really tough time in terms of raising capital because capital has been withdrawn. So effectively, I know I'm talking about things getting tougher, but I think the economic conditions get tougher, but actually if you happen to have a winning key for a winning lock, then I think actually you'll find there's real capital to be there. So we've got to find the winning keys which fit in the winning locks. Now what are they? Well, generally they're going to be companies which are able not just to survive, but actually take advantage, disproportionate advantage of those which weaken. So I think there will be companies becoming more insolvent. I think all sorts of tariffs will be introduced, not just trade tariffs. I think there'll be export bans of all kinds. I think we might see new cartels building up like we did in the 30s. So I think there's a lot going to change, and so the opportunity not just for obviously making good returns on your investment, for making outstanding returns on your investment, as we've seen perhaps with gold stocks in the last 12 months, is actually so I'm tremendously upbeat going forward.
Good. Well, I was at the Swiss Mining Institute and I showed you a chart earlier that was presented on the silver panel that I was hosting. It was by Wasif Latif from Samaya Partners, and he was talking about this return to tangibles. So I showed you the chart and we'll put that up on the screen, but it had the sort of the 1970s gold boom, it had the Japan, the dot-com boom, and now of course the sort of the tech boom. And he's now saying, right, it's a return to tangibles, a return to the hard assets. And energy is the universal currency that underlies everything. So he's extremely bullish. And I got a general sense that everyone was pretty bullish. I mean, it is a mining conference, right? So they're going to be a bit biased, but really bullish on the sector. What are your thoughts on that kind of the cycle and perhaps returning to tangibles, and how does energy perhaps fit into all of that?
Yes, I mean, one of the features of globalisation, which I was talking about earlier, is that often service companies, technology companies, these are often capital-light business models. I think capital-intensive business models have the advantage. When you get into a period where actually gold happens to go up by 3 times, or whatever it's done over the last 3 years, then effectively, if you have a gold mine, it's wonderful. Nobody's going to build a gold mine in 3 years. So basically, you don't just make money, but if people need gold and they want it because they're less likely to buy perhaps US treasuries, then the net effect is actually you don't just make money, you make disproportionate money. So going forward, absolutely, I back that judgment. I think inflation's probably going to be more of a problem. I think government's going to be overspending more. I think there's the debasement of currency, which we've all had, the fiat money thing. So I think all of those things are going to, and I think we've got a sea change in attitudes to come through in the fund management community. I think historically a lot of active managers don't invest much in the mining sector. They've been a bit cautious about the energy sector. They don't know what the oil price is going to be. Quite a lot of the capital-intensive financials and complicated financials they've been ignoring. If they haven't had them, they've lost out this year. Get used to it. Unfortunately, unless you change your behaviour, you're at risk of losing out in the future as well.
Well, that's really interesting, because I was talking to a young broker over there, and she was telling me that she's come from a mining background out of Canada, and she's trying to get institutions, family offices, interested in mining stocks. But she says there's a real lack of understanding, even at the institution level, of what mining is all about, what things mean. Would you generally agree on that? Is that because it's not sexy at all for a long, long time?
Yeah, I think a lot of people have built their career by saying, I invest in this investment universe, technology and such like. My clients are made out like bandits. Okay, there's a bit of volatility there, but net effect is, look at my record, I'm wonderful, and basically I don't need to do all this work in all these new areas.
Right,
so I think there's a complacency about all of this. Unfortunately, I think there are a few people coming under pressure as a result of that, and I think the market, in a way, will find those people out. If you're not willing to actually move with the times, then I think ultimately you put your career at risk.
And it's now the time then to be doing that.
Absolutely. I think gold is just the first of a number of metals which could do crazy things.
Really?
Silver's up 100% this year.
Yep.
I don't need to tell you that. Look at copper hitting new highs going forward.
Yep.
We don't know, and there's all sorts of things which might happen in all sorts of other metals, cobalt or tin or whatever. There's different people who have different views. I don't know, but the risk-reward ratio, if you happen to be in the right stock at the right time, is that you don't just make 2 or 3 times your money, you make 5 and 10 times your money.
Yeah, exactly. Well, I mean, the sense I got from different people was that we've had the kind of first wave, and that's obviously gold doing very well, silver just catching up a little bit. Cooling off, but probably more profit-taking rather than anything to seriously worry about. And I mean, some of the predictions, if you like, and it's always a mug's game, isn't it, making predictions, but gold, could be at sort of 10,000 in 5 to 10 years' time. Well, silver's going to do probably 6 times that, and the miners are going to do probably 15 times that, the equities underlying it. Do you tend to agree with that thesis? Do you think we're in for a real fun time in this?
I think, what I look at is behaviour, and behaviour isn't just what I'm saying I'm going to do, what I've done. And so a lot of fund managers haven't bought enough gold, they haven't bought enough silver, so there's still more to go. But actually, probably, if you're asking me, I think some of the better opportunities lie in some of the base metals. In a way, it's quite easy to say, well, I'm buying gold as a kind of proxy against inflation and all the rest of it. It's a little bit too easy, it's a little bit too conventional. You've probably got to go a little bit further away out of your comfort zone from that point of view. So actually, I'm much more interested in some of the other commodities, including energy, actually, than I am in gold or silver now.
So when you say energy, that's oil, uranium?
Absolutely. Yeah, absolutely. All of those. The whole point about energy, in comparison to, say, copper, is that, when you have energy, you use it. And it's gone. Whereas in case of copper, you can recycle it. Some of the telephone exchanges are full of copper, which is due to be recycled. So there's a big supply of copper coming from there. Okay. So coming back to it, it's a different market. I think people misunderstand the cornerstone nature of energy in the global economy.
Okay. Interesting. A couple of other points. First of all, on the kind of the money in the tech space. I saw a slide a while ago that had all the mining companies, the big ones in the world, in like circles, like bubbles. And then there was like Nvidia, and it basically encompassed the whole valuation of all of these companies.
Of course.
So there's probably, I guess you'd agree that there's some rotation to come out of perhaps tech and into this resource sector. And I wonder if you agree that some of that tech money could be that kind of crypto angle as well. And the reason I say that is because we saw in the summer of this year these Bitcoin treasury companies, right, and mining companies getting on board with that. And I thought that's a really cool idea to kind of take the tech, the digital currency, and marry it with the hard stuff in the ground. Tether, are you aware what Tether are doing with Tether Gold, where they're buying like a ton of gold a week?
Sure.
You know, this kind of crypto money seems to be positioning itself into the hard asset. And a company we talked to quite a lot, Valerium, who is in the tokenization space, they just signed a deal with a huge private equity fund in the natural resources space. It's a $2 billion fund, with a $200 million US deal, because they want to tokenize the whole process, from drilling contracts to resource statements, etc. And I'm starting to see, like, perhaps if we're going to see a rotation out of tech, it could be coming from the kind of crypto guys. We could kind of have, they're always against each other, weren't they? There might be like a joining of forces. I don't know what you think.
I think there's going to be an opportunity. I think crypto is going to be an important area, particularly DeFi and all the other things which come with crypto as well. So I think there's a lot to go for, blockchain assets. I think there's a lot there. To be honest, I always think that whilst you can hold gold, and there's lots of people who do hold gold in the physical form, and that's very good, it gives you real kind of independence of the monetary system and all the rest of it. Really, if you want to make money, you hold gold mining companies. So I think actually, although I fully accept that crypto might well be able to move into holding uranium and all the other things directly, right? Ultimately, I want to be invested in uranium mining companies. Thank you very much. So actually, whilst I accept what you're saying, as an investor, I'm not likely to go that direction. I'm much more likely to go and pick out the individual stocks which are hopefully digging out the ground and making a multiple of them of their investment due to the capex.
Okay. A couple of final questions. What do you think 2026 holds? How are you positioning? How do you see it?
Yeah, it's hard to say. I think what we can say is that 2025 turned out to be a much more benign year in the investment returns. 2026 may be another benign year, but let's be honest. I mean, we've got real headwinds. You can't open any AI data centers any faster than governments themselves are really struggling to get budgets through. US, UK, whatever. So basically, I think we've kind of run out of the sort of the opportunity to stimulate. Yes, interest rates might come down, I accept that, but that takes perhaps a year to work. So I think actually economically it's going to be much more uncertain. And most particularly we're going to see things out of cycle. So the US might be cutting interest rates, Japan may be raising them. So I think we're in kind of like for much more uncertain times. That's great. Actually, as a fund manager, we can pick different areas, we can extend risk. But I wouldn't be surprised actually if in due course, and I'm not saying next year, but over the next 3 or 5 years, if the market valuations peak out or don't go up much, I think earnings will go up. Okay. So maybe you get slightly lower valuations, but actually just in stock market terms, my expectation, my working assumption is that stock markets don't go up for another 10 or 20 years. So actually they flat line. And actually the only way you can add value is by picking individual stocks which buck the trend. So that's the longer term weather forecast. I'm not saying it will happen next year or next year.
But that's the secret, that's the trick, I suppose, isn't it? And I always like to try and give our audience tips or like stock picks. I always like to ask that. Or just things they can tangible. If you can't give stock picks or you don't want to do that, things they can look for. And I know I think one of the things you like to look for is like revenue generating, isn't it? So companies that are
absolutely
pre to getting into revenue, yeah? So if you can give any stock tips, that would be great. If not, maybe just a couple of things that people can perhaps look out for that Premier Miton are.
Yeah, actually, I mean, I have got some stocks I could talk about, bizarrely, I'm inside. So even if I'm not going to tell you what I'm inside on, in a way I feel a little bit uncomfortable about talking about them. And so there's so much going on, in fact, in terms of, in meetings with companies and things. The agenda has changed so fast, I probably won't talk about stocks. But what I will say is that generally, international stocks are cheap, US stocks are expensive, so you're getting into markets which are already cheap. Secondly, I think most fund managers will need to change the behaviour and get into mining companies, energy stocks, complicated financials, property intensive stocks like that kind of thing. So I think there's going to be a big change there. So most particularly, what I will say is I think the companies which come right will make disproportionate money. I think the mining sector specifically is unusually cheap relative to the other sectors. I think the rest of the world market's cheap. So the net effect is that I think, by picking your winners, they won't just win, but they will win disproportionately. I am, as I say, remarkably upbeat.
Gervais Williams, as always, thank you very much for your time.
It's a pleasure. Thank you very much, Mark.
If you enjoyed this interview, then give us a thumbs up, a like or a retweet. Subscribe to us on YouTube or follow us on Twitter and hit that notification bell to be the first to know when we release new content. There's loads of great content on our website too, across all our programmes at stockboxmedia.com. Thank you for watching.